Imagine you make the perfect prediction. You find a highly volatile tech stock, analyze its trajectory, and bet that after 12 months of wild swings, it will end the year exactly flat, 0% return. You check your portfolio expecting to at least break even. Instead, your investment in its 2x leveraged ETF is down 20%. The underlying stock didn't lose a dime, but a fifth of your money is simply gone. This happens because of a common assumption that leverage is a long-term wealth hack. Novice investors see the S&P 500 averaging 10% a year and conclude that a 3x ETF guarantees a 30% annual return. But these funds come with a specific mathematical warning. They are engineered to hit a target for a single day, not a single year. According to the prospectus, the compounding of daily returns over time creates a result that will very likely differ from the simple multiple of the underlying stock. Because of this daily reset mechanism, time is the ultimate enemy of the leveraged investor. To deliver twice the return of an indexed, a fund borrows money, either through margin or swaps, to double your initial exposure. Let's track a simple 48-hour cycle. You put $100 into a 2x ETF. The fund pairs your cash with another $100 in borrowed margin. You now have $200 working in the market. On date 1, the underlying index goes up 5%. Your leveraged fund captures double that move, going up 10%. Your equity block grows from $100 to $110. But at the closing bell, the fund must reset. To maintain that strict 2-to-1 ratio for tomorrow's opening bell, the fund is forced to borrow more money to match your new, larger equity base. Your total exposure is now $220. This creates a structural flaw. The fund manager is mechanically forced to increase market exposure because the price went up. They are effectively buying high. Now comes day 2. The underlying index falls 5%. The ETF must drop 10%. But that 10% loss is calculated against your newly inflated base, dragging your balance down to $99. Over 48 hours, the underlying index went up 5, then down 5, ending almost perfectly flat. But your ETF lost money because it rebalanced at the top. Across an entire year of a choppy, sideways market, this math creates a slow, compounding bleed known as volatility drag. The final ETF value is dictated by path dependency, the specific sequence of daily swings. As this comparison of Apple stock and its leveraged counterparts shows, higher leverage creates a wider gap during periods of high volatility. A slow, sideways chop is one thing, but the math changes even more dramatically during a massive intraday crash. If a stock plunges too fast, the fund triggers an emergency unscheduled rebalance. This is an intraday reset designed to prevent the fund's value from hitting absolute zero. This emergency brake locks in massive losses at the bottom. With the capital base depleted, the fund requires a significantly larger percentage gain in the underlying index just to return to its original price. Whether it's through the slow bleed of volatility drag or the sudden shock of an unscheduled rebalance, the daily compounding structure is built to lose value in turbulent markets. These funds are not broken. They are executing their mathematical objective perfectly, but that objective is strictly for a single day. For long-term holders, there is one final invisible friction: fee drag. These funds are expensive. Beyond management fees, they must pay constant interest on borrowed margin and cover the daily costs of rolling derivative contracts. This creates a persistent drain on your net performance that compounds every day you hold. These are tactical tools. They are built for day traders and institutions to capitalize on short-term momentum over hours or days, not years. Leveraged ETFs are surgical instruments. If you use them as long-term investments, the relentless mathematics of the daily reset will quietly bleed your portfolio dry.